Okay, good morning to all of you. Okay, I guess we are not going to wait for the others. Okay, we would rather just begin our class. Okay, so today we agreed that we're going to discuss on how we do audit uh, the receivables. Okay, audit of account receivable. And of course, by association, okay, of course, we'll be discussing the audit of sale, okay, as well as the audit of any provisions, okay, that relate to the maybe bad and doubtful debt, okay. That's what we'll be discussing in this particular topic, okay. So let me share my notes. Okay, so audit of account receivable, audit of account receivable. Okay. Okay, the first thing to note with the account receivable, okay, of course, account receivable is going to arise in case the company, okay, in case the company is making sales on credit, okay. If there's no sales that is being made on credit, then simply it implies that there's no receivable, okay. Therefore, that's the first thing to note, okay, that the receivable will arise in case the company do make sales on credit, okay. Company do make sales on credit, okay. Of course, our main concentration is going to be the unique procedure. Okay, is going to be what is the unique procedure? If you remember, under the case of inventory, the unique procedure that do apply to the inventory is the inventory count. Okay, is the company inventory count. That was the unique procedure that essentially do apply in inventory. In the case of receivable, okay, our key unique procedure is what we call the direct confirmation. Okay, which I think we shall discuss in detail later on. Okay, the direct confirmation. Okay. We are simply, okay, just to fast forward, okay, we are trying to ask the customer of the company, okay, to confirm as to whether the balances, okay, the company say that they owe them, okay, is truthful, okay. From the company side, the company might be saying that you owe us 10 million, okay. Now, from the customer, is it true that the company do owe them, okay? They owe the company the 10 million, okay? So you're simply confirming directly, okay, from the customers of the company. That referred to as the direct confirmation of account receivable, okay? Then that is going to be our main concentration for this particular section, okay? The unique procedure that apply to the case of the account receivable, the direct confirmation, okay? Simply asking through a letter, through email, okay, through phone calls, whatever it is, okay? But you're going to be contacting the customer of the company, asking them to confirm the balances from what you're going to present, okay? You as an auditor, you're going to present some figures, okay, from the company records. This is what the company say you owe you do owe them. Okay. Now, what do you confirm this balance for example? Okay. They call the direct confirmation. Okay. And as I mentioned, of course, to assess maybe how we go about it, of course, you begin with the assertion, okay? You begin with financial statement assertion, okay? What are the assertions that apply for the receivable, okay? What are the financial statement assertion that shall be applying to sales, okay? Then once you have the assertion, then you discuss what procedures, okay, can be applied, okay, on that particular account, okay? That simply is how we go about things, okay? I think you've been doing this for quite some time now, okay? Okay, and of course, as mentioned, with regard to the receivable, okay, we are going to be discussing areas that do have more or less what the SFP, okay. We discuss the receivable themselves as well as prepayments, okay, in case we have a customer who have actually prepaid, okay. The company is yet to provide the service, okay. However, the customer has already paid for that particular service, for example, okay, or for the goods, okay. Prepayment, for example, in case, for example, a customer overpays, okay, for a commodity, okay, the value of the goods that we supplied to the customer was 10 million, but the customer paid 15 million, which implies therefore, in this context, we can say that there's a prepayment, okay, of 5 million over and above what you have supplied, okay, and of course, the prepayment also become part and parcel of the receivables, okay, which of course need consideration, okay, when it comes to the audit of the account receivable. Towards the P&L, okay, the statement of profit and loss, because it's going to be sales, okay? Of course, there's going to be sales more towards the sale made on credit, okay? You're going to also have the case of the bad debt, okay? The bad debt, okay? And actually, also towards the SFP, okay, you may have, for example, we have the provisions for bad and doubtful debt, okay? The provision for the bad and doubtful debt, okay? Towards the P&L, okay, is more towards the bad debt expense, okay? And as I mentioned, the unique procedure that we shall be using is the direct confirmation, okay? Simply asking the customer directly, okay, to confirm maybe the account balances, okay, or to make a response, okay, as to the amounts they owe the company, okay? To mention, we've discussed all that also, okay? Okay, to put it into perspective, okay, where we are, don't forget we're still discussing on the substantive procedure. Okay, we're still discussing on the substantive procedure. Okay, we say this is going to be the bulk part of your work as an auditor. Okay, there's going to be the bulk part of your work as an auditor. So this is where you're trying to assess whether there could be any potential misstatement on the financial statement upon which you're going to base your final audit opinion. Okay, this is what you're going to base on your final audit opinion, okay, by going through the material accounts of your client, okay. Once of course we know that, we shall be discussing on the overall review of the financial statement, okay. For example, once you've discussed on the case of the cash, okay, which is going to be our next account, okay, then of course you're going to go to the review of financial statement, okay. Assume that you have gone through, okay, you have been able to audit every single material account for your client, okay. Now it's going to be the review, okay, and one of the reviews shall be discussing then is, for example, the events after the reporting period, okay, as per the requirement of IAS 10, okay, as well as the ISA 560, okay. We shall discuss when you meet there, okay. The receivable, essentially, don't forget, in case, for example, the company that you're auditing, okay, if the company that you are auditing, okay, the receivable balance is immaterial, okay. For example, in a scenario where the company only makes sales on cash, okay, this can happen, okay. If we have cases where the company do sell on cash, okay, which means that they have very minimum receivable balances, then as an auditor, you may not want to concentrate on it, okay. Don't forget here about the concept of materiality. Okay, so it is not a must for you to audit the receivable. Okay, it's only going to be a must in case it is a material balance. Okay, if it's only going to be a must in case it doesn't represent a material balance. Okay. Okay, so again, we are going to audit it using the test of detail as well as the case of the use of the substantive and the procedure. Of course, you're going to see this is going to be a unique procedure, of course. Okay, you're going to have you're going to have an extensive, okay, use of substantive analytical procedures. Okay. And of course, by extension, you're going to audit the sales, especially the sales that were made on credit. Okay. By extension, as you audit the accounts payable, you shall also be auditing the sales that was made more or less on the credit sales side. Okay. The unique assertion, okay, as I mentioned, don't forget you need to get to understand what assertion do we need to test with regard to the receivable. Okay, do we need to test with regard to the SFP? Okay, and of course they're going to be existence. Okay, do the receivable? Okay, the company say that at the end of the month of December, okay, we have a receivable balance of 10 million. Okay, does it exist? Okay, has this customer already paid? Okay, and this is just a fictitious figure the company is presenting. Okay. In the first place, did the company make that sale? Okay, or is the company just trying to boost their balance sheet? Okay, so does it actually exist? Was it an actual sale that was made on credit? Okay, and is it still unpaid by the end of the year? Okay, does it exist? Okay. Of course, the next thing is on completeness. Okay, has the company omitted some of their customers they made sale on? Okay, is it complete? Okay, has the company overstated or understated? Okay, there are some of the customers who have been omitted from the balance that the company is reporting by the end of the year. Okay, that's on completeness. Okay, that the company has been able to record every single sale they made on credit. Okay, on valuation. Don't forget, sometimes we have instances where the residual balances might not be presenting the closing balances, okay, that the company shall be putting on the face of the balance sheet, okay. There may be issues with it, okay. For example, if, the receivable has been outstanding for the last maybe 6 months, okay, or for the last 1 year, okay, should the company continue recognizing that as a receivable? okay? Because in case you're taking 1 year to collect the money, okay, what promise, okay, what assurance do you have that in the next 1 month or 3 months, okay, you're going to get that balance, okay? If the customer has not paid you for the last 1 year, okay, what assurance do you have that they're going to pay you, okay? Should you write them down, okay? That's going to be on the valuation side of it, okay? Then goes towards the P&L, okay, look towards the sales, okay, that's the core assertion, okay. Of course, the occurrence, the sale actually did occur, completeness, that the company has been able to record every single sale that it occurred, and of course, we have the element of accuracy, okay, and of course, this also we shall apply also onto the SFP, on the element of accuracy, okay, also shall be applying towards the balance sheet, okay. So those are the assertions that shall be discussing along the way. Okay. Okay, towards the P&L, okay, the profit and loss account, okay, I think I just mentioned the assumptions I'll be discussing. The first one is on the occurrence, okay, and of course, all sales transactions recorded have occurred and they do relate to the entity, okay. It is us who have made the sale, okay. It is a company that has actually made the sale to their customer, okay. The sale have actually occurred. It's a sale that you can go to trace. You can go to say this was a customer, okay. These are the goods that we did deliver to the customer, okay. So the sale actually did occur. That's on the occurrence, okay. Towards completeness, as you just mentioned, okay, is that all the sale transaction, okay, all the sale transaction that did occur during the year, they have been recorded. There's no any omission, okay. There's no any omission that did occur during that time period, okay. The company has been able to record every single sale transaction that did occur during that time period, okay, during that year. And of course, this transaction, okay, they have been reported at their correct values, okay. We did not give more discount than what was necessary, okay. The amount that have been reported is the accurate balances, okay. There's no someone who's trying to doctor those balances, okay. There's no someone who's trying to either over-report or overstate or understate those balances, okay. The actual amount have been recorded. Their balances, okay, the sales, okay, have been recorded at the appropriate amount, okay. And of course, don't forget, as you mentioned, okay, towards the IS 24, okay, transaction with the parties are related, okay, you have to be quite careful, okay. If the sales was made, for example, to the parties that are related, okay, sale was made to the marketing director, okay, a sale was made to the CEO, okay, was it recorded at the appropriate amount? Okay, so those sales, those transactions, okay, that do relate to the parties that are related, okay, what referred to as related party transaction, okay, there you have to be quite careful as an auditor, okay, especially towards on the element of accuracy, okay, have the balances been recorded at the appropriate amount, okay. Now towards the cutoff, because we simply need to know that the company, okay, have recorded transaction in their proper accounting period, okay. The company has recorded the transaction at the proper account period. If the sale occurred in the month of December, it is recorded in the month of December, not in the month of January, okay. That's on the cutoff, okay, in the proper accounting period, okay. Classification, of course, is well enough that in case the company, for example, you do make sales on credit, okay, of course, if possible, okay, on the detailed accounts, okay, you need to classify them, okay. These were sales made on cash. These were sales that are made on credit, okay. And of course, also towards the disclosure, we shall mention, okay, towards the disclosure, that is the notes, the financial statement, then of course, it's worth enough you make the disclosure if there were some material sales, okay, that were made to the parties that are related, okay. As I mentioned, in case the sale that was made on to the CEO of the company, okay, it is a material sale, then of course, it ought to appear on the notes, the financial statement, okay. I think we should discuss that towards the notes or the disclosure towards the notes of the financial statement or the disclosure to the financial statement, okay. Now, towards the face of the balance sheet, okay, the SFP, okay, the assertion about the account balances at the period end, okay, SFP now, okay. I just mentioned, okay, the first one is on existence, okay, that all the sale, okay, all the receivable balances that have been reported, okay, by the end of the year, they do represent actual sale, okay, they do represent actual sale that are made by the company and they are outstanding at the period end, okay. They do represent actual sale that remained outstanding by the period end. Okay, so the company is here to receive the money, but they did actually make the sale. It can be proven. Okay, essentially that's what we mean by that particular assertion. You can prove it that an actual sale did occur. Okay. And how can you prove, for example, I think we shall discuss on the existence. Okay, of course, one of them you can ask us at the company. Okay, provide us with your invoices. Okay, provide us with the GDN. Okay, you made a sale. That's true. Okay, where is the invoice you made to this customer? Okay, you did deliver the goods. Where is the good dispatch note, for example? Okay, you can ask them to provide you that, for example. Okay. The other section is on the rights and obligation. Okay, simply I think we mentioned is that the company has the right to the receipt of any future economic benefit. In short, the company has the right to receive the cash flows that do relate on that account. Okay, once the customer pay, that cash belongs to the company. Okay, that's simply mean by the rights and obligations. Okay. Now, towards the obligation side of it, okay, towards the obligation, okay, I think you mentioned also the case of the inventory, if you remember, okay, on the warranty, okay, you made a sale, okay, it's true, okay. However, do you have any obligation, maybe for example, to repair the goods that you've just sold, okay, to your customer, okay? So you may want to quantify, okay, maybe on the warranty obligation the company might be having, okay. Towards completeness, okay, simply that all sales that occurred during the time period, they have been recorded, okay. All sales on credit that have been outstanding, they all have been recorded, okay. And of course, they do represent the figure that appears on the face of the balance sheet by the end of that time period, okay. We can mention on valuation as well as on allocation. Valuation is essentially okay that can we be able to receive the money, okay. We say that this customer owes us 10 million, okay, it's true as per the book, okay, but however, do we have any assurity, okay, that you're going to get that money back, okay, you're going to get that you're going to get the money for the goods we sold on credit, okay, or could there be that there's a chance that you may never get that money back, okay. Why? Because this customer, okay, there's no chance, or this customer is about to be declared bankrupt. Are we going to get our money back? Maybe not. Okay. If that's the case, therefore, what happened? You need to write them down. Okay. So that's on the element of valuation. Okay. Are we going to actually receive that money that the customer? We say the customer owes us money. Okay. That's on the assertion relating to the balance sheet. Okay. Now, towards the notes, the financial statement, because we just mentioned, okay, towards the notes, the financial statement, that is presentation and the disclosure. Okay, we have, of course, we have occurrence, we have rights and obligation. Okay, occurrence that we are going to be all the disclosure events and transaction, they do relate to an actual transaction that did occur during that time period. Okay, they do relate to an actual transaction that did occur during that time period. Okay, and of course, the company has the right to receipt of those particular cash flows that will flow from that customer to the company. Okay. And of course, all disclosures, they are complete. Okay. Any necessary disclosure, I think I just mentioned with regard to transaction with party related, okay, we'll refer to as related party transaction, related party, okay, transactions, okay. Of course, these they do need appropriate disclosure. Okay, they do need appropriate disclosure. Okay, they need to appear on the face of the balance sheet. Okay, especially if those transactions are material. Okay, especially if those transactions are material. Okay. The cost financial information is appropriately presented and described and clearly expressed. Okay, that's more towards that we do classify. Okay, the classification has been made in the appropriate amounts. Okay. And of course, it is possible for the users of the financial statement to understand what the company, because in most cases, okay, for most accounts of the company, they're just going to present a single figure on the balance sheet. Okay, they're going to say this is, even the P&L. Okay, this is revenue, 10 million. Now, who does 10 million represent? Okay, of course, we do need a note that is going to tell us that the sales of this 10 million, okay, is from maybe these were cash sales, these were sales on credit, these were sales from M-Pesa, these were revenue that we received from home fiber, whatever it is, okay, that we have it, okay. We need a note that gives more detail, okay, on how the company was able to receive, for example, that revenue for that particular year, okay. Same applies for the receivable, okay? You have this receivable worth 10 million, okay? Now, who owes you money, okay? You may not mention them by name, for example, okay? However, we need a detailed analysis, okay, of how the customer owes you money, okay? For how that balance came about, okay? The users need to be able to understand it clearly, okay? what is to what extent should you describe it? Essentially, that is going to be a matter of judgment of the management. Okay, but essentially, the users need to be able to understand. Okay, that this is how our receivable came about. Okay, if possible, okay, if it is possible to do our call an age listing, okay, if it is possible, okay, not necessarily, but if it is possible, then the better off. Okay, an age listing simply means you're going to maybe divide your customer, okay, into how many days have they been owing you. Okay, you can have a customer between 0 and 30 days. Okay, between 0 and 30 days, these are the customer who has money. Okay, it means therefore that we expect. Okay, we made a sale maybe in the month of January. Okay, in the month of February, okay, we can see that with this are the sale that we made and we anticipate, okay, we are getting paid in the next 30 days as per the agreement. Okay, then those customer, okay, who we expect to be paid between 31 and 6 days, these are the customer. Customer A, customer B, customer C. Okay, between 61 and 90 days, these are the customer. Above 90, these are the customer. Okay, that call us the receivable age listing. Okay, not necessarily to have it on the face of the balance sheet. Okay, but to be very good. Okay, if the company can go ahead and actually do that. Okay, to break down the different receivable between 0 and 30 days, that 1 to 60. Okay, whatever classification you're going to do. Okay, but it can be very good for the customer to even make their own judgment, okay, as to whether they can be able to get the money from some of the customers who, for example, they're above 180 days. Okay, that means therefore they have been owing the customer for the last 6 months. Okay. Of course, the notes also need to be accurate, okay, on accuracy as well as valuation. Okay, so I think we did mention all that. Okay, don't forget the notes, the financial statement, they underlie what appears on the P&L and what appears on the face of the balance sheet. Okay. Okay, let's hope here. Now, the first assertion, okay, the first assertion is on completeness, okay, completeness of the account receivable. Okay. Now, what can you do as an auditor, okay, with regard to the receivable, okay, to assess whether the balance that has been reported is complete, okay, that there is no any single missing transaction that was not recorded, okay. What can you do, okay? Don't forget, these are just some, okay? Don't forget the procedures we just mentioned here. They are some of the procedures that you as an auditor, okay, can carry out. There are more that you can carry out. But these are some of the procedures that you can carry out, okay? The procedure you can carry out as an auditor is you can agree the balance from the individual sales schedule to the age receivable listing, okay, and vice versa. Now, what does that imply, okay? Let me just give you maybe use a board to maybe describe what that particular mean, okay? Company, okay, so let me have my board here. Okay, you can have the following scenario. Okay, we have maybe customer A. Okay, we made a sale worth on, let's say, on 1st of January. Okay, we made a sale worth, let's say, 10 million. Okay, on 1st of February, we made a sale worth 5 million. Okay, they are yet to pay us. So that means, therefore, assuming that now we're on that 1st of March, that's the day the company do prepare its account. Okay, when you prepare therefore from customer A, we're going to be having a balance equal to 15 million. As I mentioned, essentially the company might be preparing call a receivable age listing. Okay. Now, what normally happens is that you're going to have, you may have, okay, this is just an example. They classify customer based on the days. Okay, day 0 to, for example, day 30. Day 30 to day 60, for example, okay, day 60 to day 90, and customers above day 90, okay. So therefore, if we are on that 1st of March, okay, we are now on, sorry, this is March, not December. If we are on that 1st of March, okay, this customer, okay, we made a sale on 1st of January. It means if they're still owing us, okay, therefore they belong to each group here. This is 90 days later, because this first and this is more or less like that first. This is 3 months later, more or less 3 months later, okay. How many days? That is, okay, let's say 80 something days, okay. Therefore, they need to appear here, okay. They need to appear here because the days after made the sale is between 60 and 90, okay. Because we made a sale on 1st, okay, but now we are on that 1st, okay. Therefore, the days outstanding, okay, is equal to between 60, I think it should be 80 something, okay. It should be 80 something days, okay. Therefore, it's going between, therefore, that receivable balance, when it comes to the age listing, when it comes to the receivable age listing, they need to be between, okay, 60 and 90. Now here on 1st of February, okay, that is maybe like 6 days, maybe some days between 30 and 60, okay, we made some sale, okay, worth 5 million. Therefore, that balance need to appear here, okay. Look at here, you have 10 million, you have 5 million, okay, they need to appear here. Now, what we mean that whether you assess whether it is complete, okay, from the individual customer, customer A, trace these balances back to the age listing, okay. If, for example, this 10 million doesn't appear in the age listing, then there's a problem somewhere, okay? Because here, from the individual customer, there's a sale we have just made here, okay? We made on 1st of January. It ought to appear in the age listing. If it is not here, then of course, it means therefore there's some issue on completeness, okay? So simply trying to trace the individual balances, okay, of the individual customer to the age listing, okay, to the age listing, okay? Of course, you can have some series of customer. Okay, in this case, customer A, for example. Okay, let me just extend downwards. Okay, you can have this case customer A, 5 million, customer B, customer C, okay, customer D. Okay, so you can take a sample of customer and you try to trace those balances to the receivable age listing. Okay, to assess on the completeness. Okay, so you can have this customer A, customer B, customer C. Okay, so take a sample, then try to trace them back to the receivable age listing. If there are some that are missing, then of course you may want to assess as whether the balances the company is reporting is complete. Okay, I hope that's really clear. Okay, don't forget you take a sample. Okay, you don't have to take all of them. Okay, if there's I don't know, if you want to use whatever sampling method you want to use. Okay, maybe in case you want to base on the value. Okay, you take the customer with the highest value. Do that. Okay. But you can take a sample. You don't have to trace every single transaction, every single customer to the receivable age listing. Okay. Match the total of the age listing, okay, to the sales ledger control. Okay. So you can match the total of the receivable listing to the sales ledger control. Because the customer, the company, okay. Let's go back. Okay, so here we see that you're going to have customer who fall in this category, category 1, category 2, category 3, and category 4. Okay, so you can just add the sum total. Okay, you can simply add the sum total. Okay, here, how much is it? What's the total here? Okay, here from that from 0 to that days. Okay, the total is maybe, let's say 10 million. Okay, between 30 and 60, it is 15 million. Okay, between 30 and 90, 60 and 90, let's say 35 million. Above 90 is 10 million, okay? Then the total therefore will be 10 plus 15 plus 35 plus 10 to give us 70, okay? To give us therefore 70 million, okay? This is therefore the sales, this is the outstanding receivable, okay? Don't forget this is an age listing, okay? Of course, the company has sales ledger, they have account, okay? Now this balance, okay, ought to be part of the company sales mirror of credits that are outstanding by the end of the year, okay? Just a simple example on the T balance, okay? Now this balance here, the closing balance, okay, the balance, okay, carried down, okay? This ought to be 70 million, okay? Now if these two doesn't tally, then of course there could be somewhere things that are missing, okay? So simply trying to trace, okay, the sum total, okay, of the age listing back to the ledger account, okay, back to sales ledger account, okay? Now this balance, of course, they need to be equal. If they're not, then of course you may want to ask maybe the management as to where those balances are not tallying. Okay, that's on that particular point. Okay. Then cast and cross-cast the age listing. Okay, trial balance. Okay, before selecting any sample. Okay. What do you mean by casting? I think I mentioned the term cast. Cast is simply to add. Okay, cross-casting. Just to give an example. Okay. To explain that procedure you can carry out. Okay. Okay, let me just have a new work. We have 0 here, 30, 60, now we are 90 and above 90. Then of course between 0 and 90, between 0 and 30, we can have customer A, customer B, customer C, customer D. The balance for customer A between 0 and 30 and 10 million. So let's say million, 5, 3, and let's say 6. Okay. Therefore, the sum total, this is what we are referring to as casting. Okay. So we are casting between 0 and 30. Okay. We are adding up. Okay. So 10 plus 5 plus 3, 18 give us 24. Then you can have similar thing happening between 30 and 60. Okay, so you can have 10, okay, 15, 17, okay, and maybe 20. Okay, so then we cast again. Okay, 10 plus 15 to give us 52. Okay, you do the same for 30 and 90. Okay, and above 90. So you have a total here. So you can have here 30. You can have, for example, 90. Okay, then you can have the grand total here. Okay, let me just call it. You can have here the grand total. Okay, 24 plus 52 plus 30 plus 90 to give us that is going to. So we add all this together. Okay, this 120, 172. Okay, 172 plus 26. We have 196. Okay, we have here being 196, for example. Okay, now this is called, we have referred to as cross casting. Okay, cross casting. Okay, so just to assess all the balances. Okay, so you can cast. Okay, between 0 and 90. Okay, then you can also do a cross casting. Okay, to get, for example, here the grand total. Okay, that's what I mean by that particular procedure. Okay. Okay, so cast and cross cast the age receivable before selecting any sample to test. Okay, so trace a sample of shipping documentation to sales invoices and into sales and receivable ledger. Okay, so you can trace a sample of shipping. This is simply the GDN. Okay, let me just call it here the GDN. Okay, so we can have here the GDN. Okay, the good dispatch note. Okay, towards the sales invoices. Okay, of course they need to match. Okay, the two need to match. They can mention. Okay, that for every sale that occurred. Okay, and the company has gone ahead and recorded it. Okay, of course we do expect. Okay, the company has an attached documentation towards the sale they have made, the invoice as well as the GDN. Okay, the good dispatch note. Okay, if there's an invoice without a GDN, did the company actually make a sale? Okay, you may want to ask that question. Okay, if you can't both find, okay, in case the two can't tally, okay, those documents cannot be able to tally, could there be a problem? Could there be an issue that maybe the company is just recording an invoice with no customer they made a sale to? Okay, is in short, is this a fake sale? Okay, so of course, if the company made a sale, there must have been a dispatch. You can't just dispatch your good without documents. You need that. Okay, so because the customer, in most cases, they're going to be having they shall receive, okay, the good, and of course the sign, I have received this good from this particular company. So there must have been a GDN. Okay, so therefore, as an auditor, every sale invoice, okay, need to have a GDN. Okay, so take a sample. Okay, and of course, you all need to have that. Okay, they need to have at least those two documents. Okay, the GDN as well as the sales invoice. Okay, to us, maybe the sale order. Okay, not necessarily that it must have a sale order. Okay, a sale order form. Okay, but it could be at least on the bare minimum. Okay, they ought to be those two. Okay, the GDN. Okay, the good dispatch note as well as the sales invoice. Okay, if it's just the sales invoice without the GDN, then of course, it could be a problem. Okay, could be a problem somewhere. Okay, and of course, more towards the disclosure. Okay, ensure that all disclosure relevant to the receivable, okay, have been made. Okay, I hope it's all clear. Okay, so these are just simple procedures that you can carry out as an auditor. Okay, to assess on the completeness. Okay. Okay. Now this is just an example of an account receivable aging listing. Okay. So just like the way we have done in that case. Okay. For example, in this case, you have customer the same way we have just done 30 and 006 and 30, that 160. Okay, more or less. Okay, customer A, customer B, customer C. Okay, customer D. Total for that we can just do. Okay, we have this casting for them. Okay, then this is the cross casting. Okay, adding up all the total figures for the entire period. Okay. As I mentioned, okay, essentially, if possible, okay, okay, I know it might be quite impossible, okay, but on the company detailed account, okay, as an auditor, you should be able to ask the management to provide you with this age listing, okay. They should provide you, okay, even though it won't appear on the company, okay, annual report, but you as owner, you need to have access to this particular account receivable age listing. You ought to have it, okay. that you can able to tell that this is the sale, this is the receivable, okay? But where is it? Don't forget this, the figure that appears on the balance sheet is simply a sum total. But can you be able to track it backwards, okay, to determine this was the actual sale that are still remaining outstanding, okay, from customer A, customer B, can you be able to trace them back, okay? And that's why it is very important that you as an auditor, you don't need to ask for the account receivable, aging, or age listing, okay? I hope it's all clear to all of you, okay, towards that procedure, okay? Now to continue with completeness, okay, more towards the substantive analytical procedure, okay, you can compare the gross profit, okay, for this year with last year, okay. You can do so on product basis, okay. If the company is making has more than one item they are selling, okay, then of course you may have to compare maybe, okay, for each of the product, okay, how much it was the gross profit for each last year and for this year. If we do have some material changes, okay, if we do have some material changes, okay, then of course you may want to assess it will be justified, okay. There needs to have some justification, okay. As I mentioned yesterday, it does not mean that there could be fraud, okay, but there need to be some justification as to where we do have some material difference, okay, between this year and last year, for example, okay, or between maybe the market, okay, the industry, and for this company, if there are material differences, okay. If there are material differences, as I mentioned, it does not mean that there is a fraud occurring, okay? But it just makes you to be alert. As you should always remain skeptical throughout the audit process, okay? So if the profits figures seem not to be in line with what was the expectation, okay, then of course you may need to assess. You need to ask, okay, why that's not the case, okay? Compare the level of prepayments to the previous year. Okay, I think I've more let's carry that three. Okay, and of course, in case there's material differences between the prepayments, then of course you may want to know. Okay, why do we have the huge material differences? Okay, between last year prepayments. Okay, and this year prepayment. You need to be justified. Okay, you need to ask the money. You need to make an inquiry. Okay, from the management. Okay, as to why. Okay, there's such material differences. You can also review detailed statement of the SFP, okay, to ensure that all likely payments have been included, okay. If there are prepayments that have been, okay, if there are prepayments, okay, of course, soon enough that we also need to assess as to whether, okay, they have all been included in the analysis. And actually, okay, you may want also to get note of if a customer, okay, if a customer has overpaid for a service, if a customer has overpaid for a service, how do we account for that overpayment? Let me just to check on some of you. David.
Yes.
If a customer has overpaid for service, let me give an example, okay, so that it becomes a bit easy to understand. Assume that, for example, we have this case, okay, the company supply customer with, I don't know, let's say a newspaper, okay, so the annual subscription, okay, so the annual subscriptions, okay, for the newspaper, okay, assume is equal to, let's say, $12,000, okay. The customers paid for the entire year, okay. We are now in the month of May, okay, which means therefore you provide the service for 5 months, okay. So you have provided service for 4 months, okay, let's say 5 months, okay. You have been able to provide service for 4 months, 5 months already, okay. That means therefore you have 7 months you have not provided the service to, okay, which is equivalent to 7,000, okay. Assume that every month is 1,000, okay. So what you've been able to provide, okay, is the $5,000 service. Now, what do we do with the $7,000 which you have received, okay, but you're yet to provide the service? You got the question, David? I hope you got the question.
Okay, so yeah, I've got the question.
Okay.
Okay, so the 7,000, you'll treat it as a prepayment or I think a deferred revenue because it's something you have not yet. It's a revenue that you have not yet like realized or something like that.
Okay, so this will appear where will it appear? The deferred revenue.
to be under current, no, non-current liabilities or current liabilities, I think.
It is going to appear on the company current liabilities. Okay. Yes, that's true. Thank you, David. Okay, don't forget to appear on the company current liabilities. Okay, that's where it ought to appear. Okay, on the company current liabilities as $7,000. Okay, if that is happening, therefore, of course, where they have scenario where the customer has overpaid. Okay, the customer has overpaid. Don't forget, you have to be quite careful that they classify it appropriately. Okay. I think we shall mention it under classification, but they need to be classified appropriately. Okay, it should not be part of the company receivable. Okay, although it ought to be part of the company current liabilities. Okay, with an obligation which you are yet to provide it. Okay, that means therefore we ought to provide it as part of the company current liability. Okay. Okay, that's on completeness. Okay, that's on completeness. What about existence? Okay, what about on existence? Okay, you say that essentially that for every maybe receivable, okay, that we have reported as a company, it was an actual sale that was made on credit that we are recording, or the client have recorded. At the same time, that sale is outstanding at a given time period. Okay, because in case, for example, the customer has paid for it, then why should we report it as a receivable? It is not a receivable, as we say. Okay. Therefore, in terms of existence, okay, is first of all is that the sale actually occurred and the sale was on credit. And at the end of the time period, okay, the customer is yet to pay for that particular transaction. Okay. That's on the matter of existence. Okay. One of the procedure, okay, that you can carry out, okay, which I'm going to mention at the maybe in the next few slides, okay, is on the confirmation. I think I will just mention it, okay, on the called the direct confirmation, okay. You're going to be asking the customer, okay, of course you're going to ask through your client, okay. You're going to be asking the customer through your client, okay, to ascertain, is it true that you do owe this company or the company I'm auditing, okay, $10 million. The company say you owe them, okay, $10 million. From your side, is this figure correct? Okay, do you owe the customer? If the customer say that I don't owe them anything, okay, of course you may want to make a reconciliation. Just know as why that's the case. Okay, you may want to. It need to be a justification. Okay. If there be material differences between the figures that the customer says they owe the company, okay, if at all they owe the company some money, okay, and who the company is saying the customer owes them, okay, they need to be recall a confirmation. They need to recall a confirmation. Or that's one of the unique procedures that you can use as an auditor to assess whether that's the case, okay. If there are disagreement, okay, like I just mentioned, okay, if there is agreement, okay, or maybe the customer never replies, okay, you may want to know why is that the case that you have disagreements between the balances, okay. From the customer side, from the company side, okay, the company say the customer owes us 10 million. The customer from the response from the customer say that I only owe them 3 million. No, we have a 7 million difference. Okay, now where is this million coming from? Okay, get to understand or make a reconciliation. Okay, why the two balances seem not to be reconciling. If possible, okay, as you do send out the email, the letter to the customer, okay, you may want to give a breakdown. Okay, don't just give a figure. Okay, that the company, or says that you owe them 10 million, but you need to have a breakdown of how did this 10 million came about. Okay, so the customer, when making the response, can say that this balance is not fair, so they can pinpoint, okay, and say that I did not buy this good on this particular date. Okay, so give a breakdown. Okay, give a breakdown to the customer so that they can be able to tell exactly, okay, what is happening. Okay. If we have non-replies, okay, if we have scenario, okay, where the customer never replied to your email, never replied to your phone call, okay, never replied to a letter, okay, what do? Follow up on those non-replies, okay. Now, what would be the problem, by the way, in case you have non-replies? What do you think could be the issue? Where maybe a customer never replies to you. We shall discuss it a lot, okay, but just to fast forward. what do you think could be the case where the customer do not reply to a phone call, so they don't reply to email, okay? They don't reply to your text, okay? Just to check. Karen. Karen? Yes, Karen, we can hear you, but you're not talking.
Pardon the question.
No, the question.
Yeah.
You're too far from your mic, Karen. So the question here is, in cases where you draft, don't forget the letter you're going to be writing, okay? This letter is going to be, you're going to write the letter or the email, okay, through your client. Okay, I think I mentioned that with the case of also the inventory, okay? So you're going to write the letter through the client, okay, asking the customer, confirm the balances to our auditor, okay? The letter is coming from your client to your company, the company you're auditing to the customer of the company. The response is meant to come to you as the auditor of the company. Now, in cases where you don't get a response, okay, from the customer, what could be the issue? That's the question.
Okay, I'm not so sure, but I can guess either you might be communicating to a wrong customer.
Okay. That's one of them, by the way. Okay. What else? Okay, that's from Karen. Let's check someone else. Okay. That maybe one of them is that you have communicated to the wrong customer. Okay, let me check someone else. Kami.
Yes.
Yes.
I think it's because the customer will, the client will think that you might be pushing for him to pay also.
Oh, the customer think, oh, okay. Okay, now if that's the case, then therefore maybe you didn't communicate, or the communication was not done in the appropriate way. But it could be actually, it could be actually one of the reasons, okay, where this customer think that you are being used by the client to get the money. Okay, it could be a reason actually. It could be a reason. Okay, it could be a reason. Or maybe some cases. Okay, before I answer, check someone else. Quinta.
Yes.
Yes.
Maybe the client knows about a weakness that he didn't want confirmed by the customer, and probably would ask the customer not to respond.
Oh, so the client goes behind your back to tell the customer not to make a response.
Yeah.
Oh, okay. Okay, it can happen. It can happen. Okay. And they're all manner of possibility. Okay, but maybe one of them. Okay, as an auditor, you may want to check is, could there be a chance that maybe this customer in the first place did not exist? Could that be a possibility? Okay, that maybe the sale was made to a fictitious customer. Is that a possibility? It could be a possibility, okay? That in the first place, this customer does not exist. Even the email address you are given is a fake email address. Could that be a possibility? It could be a possibility, okay? That the entire sale was a fraud, okay? The entire sale was a fraud, okay? I don't know whether, I think I must have read the case of the CMC, okay? Okay, it was a long time ago, okay? I don't know whether they still do that, okay? But to get contract with the government, okay, to supply vehicle to the government, okay, what do they used to do? They used to just check who is the person in charge of, who is the procurement manager in this particular government department, okay? It is Mr. A, B, and C, okay? How do you get the contract? Let's just bribe them, okay? Let's get some, give them some free vehicles, okay? So that you can get a contract from the government, okay? Now, how do you record that vehicle in the books of the company, okay? Of course, it is going to be recorded as a sale because, of course, it need to be the vehicle came in, okay, but of course, it need to be accounted on how it went out. Okay? So what do you make? It's going to be a sale that is going to be recorded, okay. However, 1 year down the line, is there any possibility you're going to get that money back? The company will never get money back. Okay, so in case you are the auditor, you go ahead and maybe draft an email, okay, addressed to this customer that doesn't exist. Okay, in the first place, it was a fraud, and of course, you're not going to get a response. Okay, so those cases where you don't get a response from the customer of the company, then you may want to introspect in detail. Just try to know, okay, why the customer not respond? Could there be some fraud occurring here? Okay, so you may want to know. Okay, just remain skeptical in short. Okay, that maybe there could be fraud. It does not mean there's fraud, but maybe, okay, there could be fraud occurring. Okay, perform other procedures in cases, okay, where maybe there's non-replies. Okay, if they have exception and you have non-replies, then of course you may have to perform other procedures, because you can't force the customer to make a response. Okay, that one is for sure. You can't force it. Okay, so you as an auditor therefore become more creative. Okay, so what other procedure can I use to assess on existence? For example, you can be reviewing after-date cash receipts, okay, by inspecting the bank statement and any cash receipt documentation. Okay, just try to check. Okay, maybe has this customer maybe paid half? Okay, are there any half bid paid by this customer? Okay, and that might mean that we need to offset the balance. Okay, one of the procedure, okay, one of the fraud, okay, that is going to occur or that might occur in the case of account receivable. Because I think I've mentioned this fraud before. There's a fraud that essentially can occur. Okay, it can be quite common. Okay, it is not a must to be done by the management. Okay, but it can be done by mostly by even the junior, the cash, the one who receives the cash to the company. Okay, where essentially what might happen is that if a customer pays in advance, okay, if a customer pays in advance, okay, maybe the agreement was the customer is meant to pay at the end of the month of June. Okay, as per the company contract, the customer is meant to pay at the month of June. However, in the month of May, the customer pay. Now, the account receivable, or the one in charge of receiving the cash, okay, they know that, okay, that this amount will come due in the month of June. However, we have the money. Why don't I just pocket the money in the month of May? When the account becomes due, I'll use some other money from some other customer to offset the balance. Do you get a fraud? Do you get a cycle? Okay, but here, just let me use a graphic, okay, to illustrate, maybe to help. So let's say on 1st of April, the company make a sale, okay, let's say worth 10,000. Okay, this amount is due, or let's say on 30th of June. Okay, this is the due date. On, let's say, on 1st of May, okay, the 1st of May, the customer makes a payment. So here is a cash receipt, okay, of let's say the 10,000. Now, the person in charge of cash collection, okay, they know that this amount is due on the month of June, okay? They know this amount is going to be due in the month of June. So they take the money, use it to their own personal advantage, okay? When the account becomes due, okay, on the 30th of June, they use some money from some other customer to reduce this balance, okay? Look, the balance as per the book on 30th of June will still be 10,000. So what do? They get some money from other customer, okay, we've just paid, okay, and assume the amount is going to be due some other later date, okay, they pay off. So on that day, as at that of June, the balance will be equal to 0, okay. As I mentioned, don't forget this is fraud, okay, because don't forget the person doing the cash collection, okay, gets the money used to their own personal advantage, okay. The company was meant to get the money on 1st of June, 1st of May, okay. However, it will not be, the company won't get the money. It is being used by someone else, okay? Now, what do you call this fraud? Well, this fraud, I hope it's quite clear. Petronila, I hope your mic now is working, Petronila.
Yes.
Okay, yes. So first,
Can you say?
No, first of all, can you see the fraud there? Let's first begin. You can see the fraud.
Yes, I think it's.
Okay. Now, what do you call that fraud?
Is it? See, lapping.
Sorry.
Okay, skimming.
Skimming. Okay. Not skimming as per se. It's not skimming. Anyway, thank you for your for the answer. Let's see someone else. Emma. Emma.
Yes.
Yes.
I'm not sure.
Okay, yeah, okay, but okay. Let me check someone else. David. David?
Yes.
Yes. What do you call this fraud?
I'm not sure as well.
Okay. I think I mentioned it along. I must have mentioned some time ago. Karen.
Yes.
Yes. First, can you see the fraud? That's the beginning part. Can you? Is this fraud?
Yeah.
Karen, you're very far from your mic.
Yes, I can see.
Sorry. Yes. What do you call it?
I can't remember.
Okay, you can't remember. David, I guess you may have be having an answer. Let's check. David. Yes, David.
I think fictitious sales.
Fictitious sale? No, okay, this is an actual sale. Don't forget, this was an actual sale that was made on 1st of April. Okay, it's an actual sale. It's an actual sale that occurred. The only thing here is that the person who is doing the cash collection is one taking the money for their own personal advantage. So okay, it's an actual sale. It's an actual sale that occurred. Okay, who else? Quinta.
Yes.
Yes.
There's a lot of noise in my background and I didn't hear the question.
On the question. Okay, so there's a fraud occurring on the sale that was made on credit, okay, where the amount was due on 30th of June, okay. However, the customer paid in advance, and the person in charge of doing the cash collection knows that the money is not yet due. Okay, so what do? They take the money and use to their own personal advantage. So later on, once the account becomes due, maybe by then they don't have money. What do? They take the money from another account, pay off this account, okay, and the cycle continues. Now the question is, what do you call this fraud? Okay, where we have person using the money to their own advantage and try to use some other money to set off other accounts.
I remember you mentioned, but I've forgotten.
Yeah, because I remember I did mention this fraud some time ago. Okay, Kami.
Money fraud.
Oh, okay, I lost you. It's called what?
Money fraud.
Money fraud.
Money fraud.
Money fraud. Okay, money fraud. That's interesting.
Is this the one that you talk?
Kabi, I don't. There seem to be some issue with the audio. Sorry, is it there?
Yeah, the one that you're talking about, the bank teller who stole money.
Yeah,
Bank.
Yes, that one. It's the one, more or less. It's the one actually. Yes.
Yeah, I remember you calling it money fraud.
Wow. Okay. Petronia seems to have an idea. Here's Petronia. Let's take on Petronia. Yes, Petronia.
What about lapping? You said you take the money and then
Yes.
you replace it with another customer when they pay.
Yes. That's what I'm trying to describe. What do you call it?
I think it's lapping.
So it's called what?
Lapping.
Hey, okay. Can you write it on my? Can you write it on my screen? Well, on the chat. Right on the chat.
Okay.
Is there someone else who haven't talked? Okay, so let's check. Clapping. Okay, it could be. But it's a better term that we used. It could be, but this is a better term we used. Now, who hasn't talked? Let me see. Has Emma talked? Emma?
Yes.
Yes.
I said I'm not sure.
Oh, you said you're not sure.
Yeah.
Okay. Now, actually, this question was actually examined. If I remember, there's a question you examined asked you, define the following fraud. Check it for you. Let me just check it out for you. But actually, one of the terms that you can call it, okay? I can't remember even myself, okay? One of the terms that essentially can use, okay, as Pedro is telling us, it's called lapping, okay? One of them, that term can be used, okay, but it's not so common with the examiner, okay? The use of lapping, okay? It's one of the frauds actually, okay? However, that term is not too common with the examiner. That's what I'm trying to check on that question. So David, November 2016, question 3. November 2016, let's check. November 2016, question 3. Question 3. Okay, but examine 5 possible areas. Okay, it could be, okay, but essentially this is more towards the internal control system of the company, okay, the area of purchase, okay, as opposed to being area of sales, okay, and we can come back later on that. But let me actually get the term. December to come is saying December 29, question 3B. December 29, question 3B. Yeah, I can part view that question. I agree. Okay, in December 29, question 3B. Okay, 3B. Identify tutable virus and tutable fraud. Okay, that might be revealed or detected through the circulation of data. I agree, that's one of the question, okay? And that's one of the fraud, okay? The lapping, as Pedronist is calling it, okay? It's one of the fraud that actually you can be able to detect by or through the data circulation, okay? Let us actually fast forward, okay? So that we can get the correct term for it, okay? Let's just fast forward on the procedure. Let me just fast forward. Data circulation. Oh, I didn't take note of it. Just a minute. Okay, I'm just fast forwarding. Okay, seem not to give us more or less. Okay, what I wanted is a 5 or 5. Okay, let me share the ISA so that let's see whether it will make sense for us. ISA 505. Let me share that ISA. Okay, hope we can see it very well. Just to check us whether you can see it. David, you can see it?
Yes, I can see it.
Okay, okay, fair enough. Okay, so this ISA 505, okay, as 505 on external confirmation, okay. Our main concern is on the fraud. Let me check whether I can get it from here. Right, it has skipped me even that term. But one of the terms that can use to refer to that fraud is called glapping, okay? But there's a better term that can use. There's a better term that can use to refer to that fraud. Okay, it will come. Okay, but one of the term we can use is called clapping. Okay, it's one of the term that we can use. Are we good on? So take note of that December to 2009 question. Okay, we shall come back later to it. Okay, as we discuss the data circularization. We were discussing on existence, yes, on existence. Okay, so we shall come back to that question later on. Okay, once we discuss the data circularization in detail. So you were saying that, okay, if you do not get the replies from the customer, okay, then it's upon you as an auditor, okay, to try to check on whether you can use some other procedures, okay, whether is it possible for me to use other procedures, okay. Then essentially, if possible, then use those other procedures, okay. Because either way, you must assess on whether the accounts of your company, they actually do exist, okay, because they actually do exist, okay. Another way is, I think I mentioned, is review of a receipt by inspecting the bank statement, okay. Don't forget this fraud, okay. If you review the bank statement, okay, maybe in case there is more towards the amount was paid through the bank, okay, then that's a bit easier to trace the case of lapping, okay. It's a bit easier to trace the case of this fraud of lapping, okay. It be a bit easy, okay, to track it, okay, because definitely, okay, if the money went through the bank, okay, maybe the customer paid, okay, going back to our board here, okay, if the money came to the bank on 1st, yeah, if the money came on 1st May, if the money came on 1st May, then of course, therefore, there was a hit on the bank account, okay, of the company on 1st of May, okay. Therefore, in case the account on the books of the company, okay, was reconciled, okay, or was paid in quotes, okay, on 30th of June, then of course you can to ask question, okay, how comes the money did enter, okay, or did come, or did was credited to company account on 1st, okay, of May. However, the account was reconciled on 30th of June. Why do we have that high material difference? Okay, you may want to ask the management. Okay, you may want to whether there could be lapse of controls within the company. Okay, how comes the payment was made on 1st of May? However, the account was created on 30th of June. Okay, so you may want to ask question about that matter. Okay, by going through the bank statement. Okay, and confirming those payment versus when they were actually recorded for. Okay, could there be some fraud that might be occurring along the way? Okay. You can also examine customers' accounts and customer correspondence, okay, to assess whether the balance outstanding represent specific invoices and confirm whether those invoices, whether they are valid. Okay, was there an actual sale that was made on those customer accounts that remain outstanding at that point in time? Okay. Examine the line documentation, the PO, the GDN, okay, the invoices, okay, to verify as whether that sales actually occur. Okay, as I mentioned, essentially, you do need at least 2 documents. Okay, you need the GDN, okay, as well as you do need the invoice. Okay, you do need those 2, okay, at least. Okay, the PO not always necessarily, okay, but if possible, in case you can be able to have the 3 documents, okay, the better off. At least the 3 will show that there was an sale. Okay, you're going to have some level of comfort, okay, as always, that this sale actually occurred, okay, because here there's an invoice, okay, we have an order the customer made, okay, we do have an invoice, okay, we do have the GDN, okay, so the 3 documents can give you sort of a level of comfort as an auditor, okay, the purchase order, the GDN, as well as the invoices the company might be having, okay, so it can make your work easier as an auditor, okay. If the sale seems to appear on the company balance sheet, however, they don't have these underlying 3 documents. Okay, there's no PO, there's no dispatch documentation, we don't have an invoice. Then you may want to ask some questions to the management. Okay, how comes that they still seem to appear on the face of your balance sheet? However, we don't have the supporting documentation. Or in the first place, was there an actual sale that did occur? Okay. Then Another case here, okay, to assess as to whether maybe there was a fictitious sale, okay, maybe, okay, there was a fictitious sale, is in case we do have invoices, okay, that were paid. Let me use a graphic, okay, hope it will help us understand, okay. There's a sale that was made on, let's say, 1st of March, okay, let's say worth 10,000, okay, and a sale that was made on 1st of April, okay, worth, let's say, 5,000, okay. The customer paid, let's say, on 28th of April, okay, for the sale that was made on the 5th of the, that was made on the 1st of April. Now, you may want to ask yourself a question: which comes first? Should have this customer paid for the sale made on 1st of March, or paid for the sale that was made on 1st of April? And it makes more sense in case the customer first paid the sale that was made on the 1st of March. It makes more sense, definitely, because this is another sale. Okay, therefore, it makes more sense in case the customer paid for that sale. Okay, it might mean in case this customer paid for the sale that was made on the 1st of April, it might mean, it does not mean that that's what happened, but it might mean, okay, that maybe the sale that was made on the 1st of March was a fictitious sale. Maybe this sale never occurred, okay, because it makes more sense, okay, to have a case where the customer is paying for a sale that is the older sale, okay, other than paying for the preceding sales, okay. So if the customer paid for the sale, why is that happening, okay? Which it makes more sense to pay for the sale that was made, the older sale, more or less, okay? Because you do find, okay, that in the company accounts, okay, we do have a subsequent sale that was paid for, okay, compared to those preceding sales. Then you may want to question that, okay? You should be more skeptical that maybe the older sales, maybe in the first place they never did exist, okay? Maybe it was just a fake sale that the company did report on its book, okay, when they were preparing maybe the balance sheet, okay, as a 30th of maybe March, okay? So you may want to verify the case, okay? And especially in cases where the subsequent sales have been paid for, okay? And the old ones, okay, they have not been paid for, okay? You may want to get an explanation, okay, of course, from the management. Observe whether the balance on the account is growing, and if so, find why that is happening and have a discussion with management. What does that mean? If we do have cases where, let me just go back to our this customer here, okay, that the company made a sale, okay, let me just rub this off, okay, there's a sale that was made on 1st, okay, there's a sale that was made on 1st, okay, of March, okay, equal to 10,000. A sale that was made on the 1st of April was 5,000. It makes more sense that as a company, before you make any other sale, even before you make this sale on the 1st of April, okay, you may want to ask the customer, already you owe us 10,000, okay, why don't you first pay the 10,000 before we do give more credit to you, okay, because already you owe us money, $10,000, then first pay the $10,000, okay, then again discuss how we're going to give you more credit, okay. That's what happened here, that if this balance is increasing, okay, 15,000 at the end of the month of April, month of May, we make another sale on credit, okay, equal 10,000, and you're yet to get paid all these other balances up there, okay, then it seems not to make more sense, okay? Why do we still give more credit to customers who don't pay us money, okay? Then in case that's what's happening, that the balance is increasing throughout, then that might be, it could be there fraud there, okay? We just skeptical. It doesn't mean that there's fraud, okay? But we may need a justification as where the balance is always increasing, but we seem not to, in quotes here as the management, okay? Because see, it makes more sense that before you can make any more sales, you first pay us what you already owe us, okay? So in case the balance is increased throughout, okay, then you may want to question the management, okay? What's the intention as a management, okay? Is it to lose your goods? Because here it seems that if you might end up losing your money, okay? First get paid the money before you can extend any further sale on credit, okay? Okay, that's on the existence of the account receivable. Okay, some of the procedures that you can use on the existence of account receivable. Okay. Now, towards the rights and obligation, okay, look here, the rights simply mean that we do have the right, the receipt of the potential cash flows, okay, that will come from any payment we shall be making, okay. We are the one who should be receiving that account. We should be receiving any cash payment from the customer, okay. That's on the rights. Obligation, I think I already mentioned, okay, in case of cases where maybe you do provide warrants, okay, there's a warranty obligation, then has the company gone ahead and made a recognition, okay, in these books for any potential warrant obligation, okay. And the procedure you can carry out is inspect the bank confirmation letter, okay. We shall discuss it about what referred to as the bank confirmation letter, okay, where, as mentioned, you're going to draft a letter, okay, address the bank, okay. Of course, you're going to draft through the client, okay, not you who is going to write the letter, but of course, the client is going to be guiding how the letter is going to be written. You address this to the bank, okay. Ask the bank, okay, is there any of the do you have a fraud in charge on my client, maybe account receivable, okay? Because in case there is a fraud in charge on the account receivable, okay, and maybe the company has contravened one of the agreements on the loan agreement, okay, then of course it might mean the company has no right to the receivable, okay, which might mean that maybe the company ought not to recognize, okay, those receivable, and especially in case it was a material breach of the loan agreement, the loan contract, okay. Just if that's the case, okay. If the company, okay, has used factor, okay, what the factor was factoring, that is, they have sold the account receivable, okay, to a factor, okay, then should the company continue making that recognition? No. If, for example, okay, is a case where now the factor has taken over, the company has received, okay, especially in the case of the non-recourse arrangement, okay, hope you should remember those arrangements, okay. In the case of, for example, in the case of the non-recourse arrangement, okay, then the company have no any further rights, okay, towards the receivable, okay. So that means therefore it is upon now the factor or those receivable belongs to the factor as per se, okay. Those receivable belong to the factor. Or even has the company actually made a sale of those account receivable, okay. Okay, have then been sold, okay. What we call invoice discounting. Hope you should remember, okay. I think this was from your finance, okay. In the case of invoice discounting, okay. Okay, have they done an invoice discounting? Okay, now this is an outright sale of the account receivable to a third party. Okay, the company have no right to the receipt of any future economic benefits, okay, from those receivable. So what happened? The company ought to, therefore, in the book on their books, okay, they ought to recognize those receivable. Well, they have sold them. Okay, they're just like any other assets. Okay, therefore the company should continue making recognition of those receivables. Okay. You can also inspect loan agreement and of course the minutes, the board meetings to assess as whether there's any evidence of the sale. Okay, has the company gone ahead and made sale of the account as well? Okay, but of course checking the board meetings. Okay, by asking the board members. Okay, or by asking the board to provide you with the minutes that they had a discussion on the sale of their account receivable. Okay. Also, you may want to ask, okay, more or less this can also apply with the first point, okay. If the receivable have been used as collateral, okay, they have been discounted, I think I already mentioned that, okay, and whether such disclosure is necessary towards the financial statement, okay. So, as a management, okay, have a discussion with the management whether any of the receivable have been used as a collateral, okay, against a loan, okay, and of course, as I mentioned, check as whether either, okay, the company is in fulfillment, okay, of the obligation contained in the loan agreement, okay. Has the company gone against the provisions of the loan agreement? If they have, okay, what does it mean? Okay, what's the repercussion, okay, of the company not being adhering, okay, to the agreement they had with the provider of finance? Okay, does it mean the ownership passes to the bank, for example? If that's the case, then of course the company ought therefore not to make any recognition of that receivable in their books. Okay. If they have been discounted, I think I mentioned the case of the invoice discounting. If they have been discounted, okay, that same thing apply. Okay, the company made an outright sale to a third party, to a factor, for example. Okay, therefore the company have no right to receive any money from that account receivable. and therefore they all don't appear, okay, towards the face of the balance sheet. However, okay, the company can make a disclosure, okay, towards the notes, the financial statements, okay. They can make a disclosure, okay. They can tell the users, yes, we have sales worth X amount of money, okay, that one on credits, however, they have been discounted, okay. So you won't see them on the face of the balance sheet, okay. However, more or less, we did make a sale, okay. We have made the sales on credits outstanding, okay. They have been used as a collateral, okay. Therefore, to the notes, the financial statement, they need to be quite complete, okay? And the users need to understand quite well, okay? The element of understandability. The notes ought to give the users enough information for them to be able to understand what is happening behind the doors, okay? That's on the rights and the obligation, okay? On the right and the obligation, okay? Just examples of some procedures, okay? I'll just maybe some of the procedures that you can carry out to assess as to whether, okay, the company has the right to receipt of any potential cash inflows, okay, from those sales. Question? Okay, so if there's no question, okay, I would propose that we end the class there, okay? Our next session is going to be on valuation, okay, on valuation, okay. In the meantime, okay, let me, I'll share the ISA 505, okay, for your own consumption, okay. I'll share as 505 for your own consumption, as well as, okay, you go through it, because one of the unique procedure that I mentioned, okay, is contained on that ISA, okay. That is the customer data confirmation, on the so-called the data circularization, okay. Yes, Quinta, you have a question.